Hello and welcome to week 8. We are continuing our life premium calculations. This is just a really small talk on how to calculate life premiums, and you're going to pass mock exam today. So our discussion of life insurance would not be complete without a discussion of how life insurance premiums are calculated. And we briefly introduce the fundamentals of premium calculations and policy reserves of life insurance. And the first thing we are going to start with is net single premium. Although most life insurance policies are not purchased with a single premium, the net single premium forms the foundation for the calculation of life insurance premiums. The net single premium is defined as the present value of the future death benefit. It is that amount which, together with compound interest, will be sufficient to pay all death claims. In calculating the NSP, only mortality and investment income are considered. Allowing for expenses will be considered later when the gross premium is calculated. The NSP is based on three basic assumptions. Premiums are paid at the beginning of the policy year, death claims are paid at the end of the policy year, and the death rate is uniform throughout the year. Certain assumptions must also be made concerning the probability of death at each attained age. Although life insurers generally develop their own mortality data, we will use selected data from the 2001 Commissioner's Standard Ordinary Mortality Table for male lives in our illustration. So the 2001 CSO table shows mortality data from ages 0 to 120. Finally, since premiums are paid at the beginning of the year and death claims are paid at the end of the year, the amounts needed for death claims can be discounted for the time value of money. It is assumed that the amounts needed for death claims can be discounted annually at 5.5% compound interest. The NSP for term insurance can be easily calculated. The period of protection is only for a specified period or to a stated age. The death benefit is paid if the insured dies within the specified period, but nothing is paid if the insured dies after the period of protection expires. The NSP for yearly renewable term insurance is considered first. Assume that 1,000 yearly renewable term insurance policy is issued to a 32-year-old male. The cost of each year's insurance is determined by multiplying the amount of insurance by the probability of death, which is then multiplied by the present value of $1 for the time period the funds are held. So by referring to the 2001 CSO mortality table for males, we see that out of 9,778,587 males alive at the beginning of age 32, it is expected that 11,050 males will die during the year. Therefore, the probability that a male age 32 will die during the year is 11,050 divided by 9,778,587, or this probability. The amount of insurance is then multiplied by this probability to determine the amount of money the insurer must have on hand from each policyholder at the end of the year to pay death claims. However, because premiums are paid in advance, the death claims are paid at the end of the year, so the amount needed can be discounted for 1 year. From this table we see that the present value of $1 at 5.5% interest is 0.9479. Thus, if 1000 is multiplied by the probability of death at age 32 and the product discounted for the time value of money, the resulting net single premium is 1.07. So 1000 we will multiply on this result, and we will multiply again on this value. So 1000 times 11,050 divided by 9,778,587 times 0.9479 equals 1.07. So if this $1.07 is collected in advance from each of these amount of males who are alive at age 32, then this amount together with compound interest will be sufficient to pay all death claims. Next point of interest is 5-year term insurance. In this case, the company must pay the death claim if the insured dies any time within the 5-year period. Thus, the cost of each year's mortality must be computed separately and then added together to determine the net single premium. The cost of insurance for the first year is determined exactly as before when we calculated the net single premium for yearly term insurance. Thus, we have the same calculation, 1000 times this probability times 9.9479, and we got 1.07. The next step after that is to determine the cost for the second year. And looking again at the table here, we notice that at age 33, it is expected that 11,233 males will die during the year. Thus, the previous year amount of males who were alive at age 32 and the probability of dying during the age 33 is 11,233 divided by that amount, that one. And just note that the denominator doesn't change but remains the same for each probability calculation. So because the amount needed to pay second year death claims will not be needed for 2 years, it can be discounted for 2 years. Thus, for the second year, we have 0.8985. So the amount of 1000 times this value divided by this value times this value will give us 1.3. So for each of the remaining 3 years, ages 34, 35, 36, we follow the same procedure. And the calculations for the entire 5-year period, we can see them over here. And if the insurer collects 5.04 in a single premium from each of the 9,778,587 males who are alive at age 32, that sum together with compound interest will be sufficient to pay all expected death claims during the 5-year period.